So just in case some of you are learning this for the first time, let me do my best to just review the basics quickly. Is that okay? All right. Now, basically, what are options? Options are contracts. They are contracts, all right? And there are two kinds of options: call, right? Remember, call and put. So call is like I'm calling, I'm buying. Put is like I'm selling, okay? So what's a call option? When you buy a call option, you have the right to buy 100 shares of a certain stock at a fixed price, that you have locked in. We call that the strike price. So for example, if you buy a call option on Apple at the strike price of $150, what does it mean? That means you have the right to buy Apple shares at $150. So no matter where Apple goes, you can buy at $150 within an expiration date, right? Because the option will expire within a certain date, right? So if Apple goes to $200, hey, you can still buy at $150 because you locked in the price. Apple goes to $300, you can still buy at $150, right? So that's a call option. When you have a call option, it locks in the price. Make sense? And when you buy a call option, you want the stock price to go as high as possible because you can buy it at the low price and then sell it at a higher price, make a profit, okay? Put options are the opposite. When you buy a put option, you're buying a contract, okay? You're buying a contract that gives you the right to sell 100 shares of a certain stock at a fixed price. Again, we call that the strike price. So again, if you buy a put option on Apple with a strike price of $150, what does it mean? It means you have the right to sell Apple shares at $150. So no matter where Apple price goes, you can sell it at $150. So even if Apple goes to zero, who cares? I can sell it at $150, right? Because you locked in that price. Of course, within that expiry date. So normally people who buy put options, they want the stock price to go down, right? You see, go down, you bastard, because I can still sell it very high, right? And they make money when the price goes down. All right, so that's a very quick summary of calls and puts. Okay, guys. Now, if you look at most amateurs, most newbies in options, what do you think most people like to do? All right, most people, especially those on Wall Street bets, right? They like to focus on buying options. They like to focus on buying call options to bet that a stock price is going up. So they say, I think the stock price is going to go up. They buy a call option, right? How many of you, I'm just curious, have done that before? You think the stock price is going up, you buy a call option. Who has done that before? Right? That's the most common way people use options, right? Now, I got news for you. If you buy call options to bet the stock price is going up, I can bet you that in the long run, you will always lose money. You will always lose money in the long run. I can bet you that. Why? Okay, here's why. You see, when you buy call options, yes, once in a while, you can make a lot of money if the price goes up a lot, once in a while, okay? But in the long run, you're going to lose money. You're going to lose money, right? Because buying a call option is like buying a lottery ticket. It's like buying a lottery ticket. You're going to make money once in a while, but more often than not, you're going to lose everything back. That's why most amateurs who trade options always lose money because they make the worst mistake, which is they just buy call options. Okay, why? Now, take a look at this chart over here, all right? When you buy a call option, you only make a profit. Can you see this over here, profit? You only make a profit if the stock price goes up fast enough. The stock price must go up fast enough. If the stock price goes up but not fast enough, you lose money as well because options are a decaying asset. Every day they lose value, they lose value, they lose value until they expire on the expiry date. So time is working against you. So not only must you be right on the direction, but you must be right really fast, which is really difficult. which is like, again, striking the lottery, right? So you can see again over here, when you buy a call, you only make money when the stock price goes up in time, right? But if the stock price goes down, or the stock price goes nowhere, doesn't go up enough, you lose money. Now, think about it. The stock price does three things. The stock price can only either go up, or stock price can go sideways, or stock price can go down. True? Generally go up, sideways, or down, right? So when you buy a call, you are only making money in one out of the three scenarios, right? You are only making money in one out of the three scenarios when you buy a call. Same thing. When you buy a put, same thing. You only make money if the stock price falls fast enough. If the stock price doesn't drop fast enough, you lose money, all right? So again, whenever you buy a call or put, your chance of making money is one out of three. That's why most people lose money in the end, because it's like buying the lottery. You see what I'm saying? So you notice that most professional option traders that make money consistently, you know what's their secret? They are not net option buyers. Yes, they do buy options once in a while, but rarely, okay? Most professional option traders like myself and Bang, we are net option sellers. That's the key to making consistent profits, to be a net option seller. Now, here's a very important warning. Write this down, write this down. When you sell options, never sell naked. All right, always sell with your clothes on. Okay, now what does it mean? Later I'll explain, right? If you sell options naked, it is very risky. You can die, you can go bankrupt. So when you sell options, you must always hedge it. You must always hedge it. So later I'll talk about how we hedge it and how we use cash to secure the option sale. All right, so please, please, please do not sell options without hedging it. Okay, very, very important. Now, my favorite strategy, which is again, this accounts for 90% of all my profits actually, is actually selling put options. All right, my main way of making money in options is selling puts. All right, now why? Why selling? Again, notice one thing. When you sell an option, time is working in your favor because every day the option loses value, loses value, loses value, loses value. And when you sell options, you want them to lose value. The more they lose value, the more money you make, because you want to sell high and buy low, or sell high and never buy it back. Make sense? Now, also notice, when I sell a put option, I make money. Look at this. Can you see this profit here? I make money if the stock price goes up, and I also make money if the stock price goes nowhere. Right? So stock price goes up, I make money. Stock price goes nowhere, I also make money. Now, if the stock price goes down, actually, I also make money. You say, how do you do that? I'll show you in a while. All right. Now, when you buy great companies, they will always go up eventually. But again, they must be fundamentally good companies. They will always go up. So I'm not afraid of this scenario because the price could go down temporarily. It's going to go up eventually. So it's a win-win for me. I never lose money. All right. When I sell cash secured puts. Again, I'll share with you the details in a while. Just hold on to your horses. Now, but if I'm trading, right? Yes, I could lose money as well, obviously, if I'm trading. But when I'm trading, the stock price has to collapse to lose money. That means even if the stock price goes down a bit, I still make money. It has to collapse. But of course, if it collapses, I have to cut my losses. And I'm going to show you all this in a while. All right. So far, you guys following me? Does this make sense? So like I said, as professionals, we want to be net sellers of options. Okay. If you're a net buyer, you are a gambler. Once in a while, you make money. In the long run, you're going to lose everything. Okay. Because 80% of options expire worthless. So if you buy an option, then the chances of you making money is quite rare, actually. All right. Yeah, once in a while, you're lucky you make money. Okay. So if you guys have been watching our interviews with students, by the way, do catch the interviews with students because they share a lot of their thoughts and their feelings about how they went through the journey. And many of them admit that, again, at the beginning, they were struggling, right? They didn't understand what was going on. It was confusing. But once they understood it, it changed their life dramatically. And if you watch the interview I did with Mary, I keep forgetting how to pronounce it. Marie, right? Marie is in the US. She's originally from Japan. And if you read her testimonial, she said that, I've been trading for years, but I only knew about, calls and puts, just buying calls, buying puts. So I was making a lot of money, but then lost almost everything. After that, I made more money, then lost it again. And I was just going in circles. And this is very common. Like I told you, you make, you lose, you make. In the end, you don't make money, right? After I joined Piranha Profits, I studied so hard, blah, 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 blah. And she said, this year alone, I'm up more than $35,000. All right, my favorite strategies are snipebacks, bull put spreads, bull bang with collar. So again, notice that the fundamental difference was she changed from being a net buyer of options to a net seller of options. And that's what transformed her trading profits, okay? So let me now, again, for the benefit of the newbies, explain a put option in greater detail, okay? So like I said, I'll only focus on put options today because that's my main strategy, right? Okay, so again, a put option is a contract. So when you buy a put option, you're buying a contract that gives you the right? You have the right to sell 100 shares of a certain stock at a fixed price that you have chosen. We call that the strike price. And you can sell the shares at that price anytime before or on the expiration date. So example, let's imagine you have got this put option. This is the Intel September 50 put option. So what does this mean? All right. So what this means is this put option is on Intel stock. Okay. So if you buy this put option, you have the right to sell Intel shares at $50 anytime before the expiration date. It expires in September in this case, right? Of course, to have this special right, you have to pay a premium. So the premium is $1 in this example. So a put option is like buying insurance. Think about it. It's like buying insurance. It's like buying fire insurance on your house. You pay a premium, right? And once you pay the premium, what happens? You insure your house for, let's say, $500,000. Okay. So if your house is damaged in a fire and the house drops to $250,000, what happens? Don't worry, you can still claim the $250,000 loss from the insurance company, correct? So same thing here. By paying $1, you are insuring your stock at $50 that you can sell Intel at $50. So even if Intel drops to zero, doesn't matter, you can still sell it at $50 before September. Does it make sense? So think about put option is insurance. You're buying insurance when you buy a put option. So for example, let's imagine that now Intel stock, let's imagine that Intel is now selling at $50. This is the share price, okay? And you buy this put option on Intel, okay? And what happens is after you buy the put option, Intel share price drops to $45. Are you happy? Are you happy? Yes or no? Yes, you're happy. Why? Why are you happy? Because you have the right to sell Intel at $50. But now it's at 45, right? Ha ha ha. So theoretically, you can buy the shares in the stock market for 45 and sell it for 50, giving you a profit of $5, right? So now your options are worth at least $5. We call that the intrinsic value of the option. In reality, it's actually worth more than $5 because there's also time value, but it's worth at least $5. So that means that from $1, the option is now worth $5. So what could you do? You could sell the option for profit, right? You bought the option for $1, and now that the stock price went down, the option is more valuable. Option is now $5. If you sell it at $5, how much you make? Buy at 1, sell at 5, you make $4. Correct? So you can see when you buy a put option, you are hoping the stock price goes down. Stock price goes down, your puts are worth more. And you can make money by reselling the put at a higher price. Okay? Now, what if you buy this put option and Intel's stock price doesn't go down? It stays at $50, just stays there. Or it goes up to $51. And by expiration, it stays at 50 to 51. Then what happens to this put option? This put option becomes worthless, right? Because now you have the right to sell Intel at $50, but Intel's at 51. So why would you want to sell it at $50? So this option becomes worthless, right? So when you buy a put option, what's the worst that can happen? What's the worst that can happen when you buy a put option? The worst is you lose the premium. You lose $1, right? But if the stock price goes down, then your put option can make a lot of money. Does it make sense so far? Okay? Okay, now, so that's why people buy put options to bet that the stock price goes down. But later I'm going to show you that I do the opposite. I sell put options. Why? I'll explain in a while. Hold on. Okay. So when you go into the market, you can play two roles. You either be a buyer of the put or the seller of the put. You can play either role. All right. So if you buy a put, you have to pay the premium. Remember, the buyer always has to pay the premium. When you buy insurance, you have to pay the premium, right? So as a put buyer, you pay the premium. Who collects the premium? Who collects the premium? The seller of the put. So when you sell a put, you collect a premium. It's like you sell insurance, the insurance company sells you insurance, they collect your premium. Okay? So for the person who buys the put, they pay the premium, and by paying the premium, they have the right. They have the right to sell the stock at the strike price, which is the fixed price, example, $50. So like I said, put buyer, they want the stock price to go down, right? If it goes down, put buyer makes money. If stock price doesn't go down enough, they lose money. Okay? Now, for the person who sells the put, why do they sell the put? You sell the put because you want to collect premium. The purpose is to collect premium. But by collecting the premium, the put seller is now obligated. He's obligated to what? To buy 100 shares of stock at $50. In options, one contract is always 100 shares. Remember that. One contract is always 100 shares. Okay? So for the put seller, generally, he's hoping that the stock price will stay where it is or go up. Why? Because if the stock price stays there or goes up, what happens to the put? If the stock price stays there and goes up, the put becomes worthless. And when the put becomes worthless, the seller is no longer obligated. Ha ha ha, I took your premium, now I have no more obligation. Make sense? All right? But later, I'm going to show you that as a put seller, even if the stock price goes down, I am happy. All right? I'm going to show you why in a while. Only if you do this on good companies. Okay. So now that we've covered the basics, Now we've covered the basics. I want to show you my first strategy. And this is a very simple strategy that is very profitable. Okay. So this strategy is called selling puts. But like I said, don't sell naked. Don't sell naked. Sell cash secured puts. Okay. Now, why do we do this? We do this to get paid every month while waiting for the share price to drop to our desired level. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.